After another wild week in the financial markets, we'll review the latest charts and data to help us answer the question, will Fed policy bring a recession and lower lows in stocks? You may remember in last week's video, we talked about the market's primary problem, inflation. This quote from Fed Chairman Powell earlier this week, December 14th, sounds like it came directly from the "we will not make the same mistakes that were made in the 1970s" script. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The initial reaction to Tuesday's CPI report was very favorable. In fact, the S&P 500 future shot up to 4145. And then Chairman Powell focused on the primary problem in the press conference. He stated that core inflation running at 6%, that's 3 times our 2% target. The Fed started telegraphing the message that was delivered on Wednesday of this week back in October and reminded the markets again on December 5th what was coming this week. The Fed delivered what had been telegraphed for weeks, and the market didn't like it. And the technical setup heading into the Fed meeting wasn't particularly favorable either. Daily S&P 500 chart, you can see we gapped open on Tuesday after CPI, but we printed a 913, signaling potential trend exhaustion. And intraday on Tuesday, the market reversed at somewhat of a logical level. You could say this level here is similar to this level here. And in this case, when we were rejected at the trend line and RSI dropped below 50, bad things happened. In this case, when we were rejected near the trend line and RSI dropped below 50, bad things happened. After hitting 4,100 during Tuesday's session, the S&P 500 during Friday's session on December 16th was hovering around 3,850, with daily RSI around 42. Back on October 21st, Wall Street Journal article, the Fed telegraphed what was going to happen this week. They reminded the markets again on October 30th, and again on December 5th, and in countless public appearances since the October low. As we've talked about in recent weeks, if the Fed believes that they need to see a higher unemployment rate to take the pressure off wages and hence bring down inflation, historically higher unemployment, especially of this magnitude here, tends to usher in an economic recession. And during recessions, typically earnings per share, take a big hit. And based on the number of earning revisions that we've seen to date, it's very, very possible that forecasts are going to be cut significantly in the coming weeks. And thus, it's very, very possible the markets are now shifting from the primary focus or primary fear being inflation to that primary focus or primary fear being an economic recession. And based on the economic data that we have in hand, most likely that's going to be a global recession. And despite the recent strength in foreign stocks, they also got hit with 4 913s on the daily chart of ACWI this week. Doesn't predict anything, it speaks to probabilities. And if earnings are going to come down, then an S&P 500 trading above 3,800 could still be significantly overvalued. 2 weeks ago, we talked about the possibility of the bond market outperforming the stock market during the next phase of the bear market. And it's possible that the first step is outperformance, relative performance, and the second step would be absolute performance. Said another way, it's possible that both stocks and bonds will lose money for a few weeks here, and then if history is any guide, it's possible that bonds would become profitable before stocks. It does appear that that shift is occurring relative to the markets becoming concerned about a recession. This week, TLT or long-term treasury bonds beat SPY or the S&P 500 by 3.71%. That's intraday on Friday. And monthly, TLT's beating SPY a little over 11%. And while the trends in most bond ETFs remain firmly down at this point, they are showing some signs of a potential bullish reversal. For clients, we'll be looking for opportunity to put some of that position-traded money market money to work in the coming weeks. Still may be a little bit early for bonds, but it's not too early to consider starting some positions and or being ready for a turn. And we know relative to history, if we're getting ready to enter a recession, it's possible the stock market has not put in its final low. And last week, when we used charts to answer the question on your screen, we stated that the Nasdaq's trend, the weekly trend, was still unequivocally down. It's hard to change that assessment this week. This chart's dated December 9th. For the full week, roughly, the Nasdaq Composite was down approximately 3% for the week. That's as of 2 p.m. Eastern Time on December 16th. And history also says if we're heading into a recession, the first rate cut from the Fed won't necessarily bail out the stock market. And we are starting to see some recessionary-like numbers here. These are PMI numbers here, 46 and 44, both below 50. These were released on Friday, December 16th. Below 50 indicates economic contraction. If these readings get much lower, potentially that should help the bond market as the market looks forward to the Fed backing off. How about the VIX? This is the VIX of VIX, VVIX. It speaks to expected volatility in the VIX. Here's where the S&P 500 peaks Q4, Q1 of this year. Here, VVIX spikes up here, makes a lower high. You could make an argument that breaking the trend here is similar to breaking the trend here. This high, possibly similar to this high. This lower high, possibly similar to where we are in the present day. Like all of these charts, they don't predict anything, they just speak to probabilities. And currently, the VIX is still trading in the 20s, and history says it could go much, much higher before the stock market puts in its final low. Where do we stand relative to the S&P 500 charts that we covered earlier in December? The larger chart here dated December 2nd. The smaller chart's a weekly chart, Friday, December 16th at 11 a.m. Eastern Time. On December 2nd, it was very difficult to say that this looked like anything other than a counter-trend rally within the context of an existing downtrend. But for the most part, you could say that at every major low in history in the early stages. As we noted earlier, the S&P 500 traded all the way up to 4,100 this week after CPI. So on this chart over here from December 2nd, that would put us somewhere in this area here, but still below the downward sloping trend line. And we closed Friday at 3852, right near this relevant region here. Now, last week in the summary slides, we said 3960 to 3943-ish was relevant. And then we said the intermediate range relative to possible support was somewhere in the neighborhood of 3908 back to 3899. Well, right now we're below all of those levels on Friday at the close at 3852. As we know, the longer below, the more relevant it becomes. You may remember on December 2nd, the big chart here said we're still in a downtrend, but momentum really hadn't rolled over in any meaningful way yet at that time. That's not true anymore. Bullish momentum, especially on a daily time frame, tends to dissipate quite a bit when you move from a 4100-ish type level down to a 3845-ish level, as we did this week. That's about a 255-point drop from the peak to the level around 11 a.m. on Friday. So thus far, the S&P 500 hasn't cleared any of these levels that we've been talking about in the past few videos. If it rights itself next week, all of the levels are still relevant, including a little bit over 4,200. Shifting gears to a wide variety of charts from this week. Dow Jones Industrial Average advanced decline line. Resistance stalled in a similar area here. You can see this is the Dow Jones Industrial here in January of this year. This is August of this year, and this is the present day. We've covered this chart numerous times. To date, we still don't have a favorable turn-up look relative to what we're looking for. From an intermediate term perspective, the Nasdaq's 50-day moving average is starting to look vulnerable. S&P 500, advanced decline volume, similar concepts, turning down near a logical area. A similar chart for the Nasdaq 100 has been all the way down into this area here earlier in 2022. It's a daily chart of the Nasdaq relative to the NYSE composite. This is a very vulnerable look over here. This is the 50-day. This is the 200-day here. Market looked very, very vulnerable in here, and it held. The difference here may be that the market is starting to become very, very concerned now about an economic and earnings recession. You can see the daily Netflix chart down here. Back to a logical level. This is a huge gap that was present on the daily chart. Right now, we've come back, filled the gap. We've started to fall in the other direction. Notice even in the dot-com bust bear market, long-term monthly momentum for the NASDAQ composite started to turn up in calendar year 2001 down here. The final low in the NASDAQ really doesn't come until the retest in the spring of 2003. Moral of the story, this is a concerning look here. And it says A, we should be open to a retest of the lows, and B, open to lower lows. Thursday's session, we're giving up an important volume by price area here on the NASDAQ composite. ARKK relative to TLT, starting to flirt with the 2020 COVID low and below the monthly cloud. Monthly MACD for the ratio below 0, saying this is in a monthly downtrend. Tesla weekly, ugly looking weekly candle here during Friday's session, 3:21 p.m. Eastern Time. This is the all-important 200-week moving average. Weekly MACD well below 0. Price well below the weekly cloud. NASDAQ weekly as of Thursday's close, still clearly in a downtrend. Under a major low scenario, at some point, this line and this line would have to be exceeded on weekly RSI. Right now, we have a lot of white space in here. This is the dot-com bust bear market, this is the financial crisis, and this is the present day. NASDAQ weekly as of Thursday's close hasn't really done anything to break the downtrend here. For the most part, we've been stalled underneath the 200-week moving average. Now we're at the intersection of the downtrend and the 200-week with very, very weak weekly momentum. Weekly MACD also well below 0. Broad Dow Jones Composite common theme. Weekly chart having trouble at a very, very logical and downtrend-like level. Is it possible we're in the final stages of this bear market? Based on some of the movements that we've seen in the bond market, we probably are getting closer. But keep in mind, the final leg down in a bear market can be very, very painful. Very, very easy to make the argument that this look in 2008 here is somewhat similar to the present day. If you're a stock market bull, you want this look right here to morph into something more like this 2010 look, which is absolutely positively within the realm of possibility. One of the leaders off of the October low looks like an impressive breakout here in late November, early December. Now it looks like a failed breakout with a concerning head and shoulders type look with a downward sloping neckline. Longer below, the more relevant it becomes. Longer above, the more relevant it becomes. And notice, we weren't above for very long. NASDAQ 100 relative to the S&P 500, this is a daily chart. We've had a vulnerable look before. The difference here could be recessionary fears. The S&P 500 started to rally on October 13th. Look at ARKK. It basically didn't participate in that rally. On December 15th, well below the June low here. Nowhere near the August high. We've talked about this concerning look on the monthly cloud in the past. Not a good look when you get a cross like this, 2001. Blue below red here, 2008. It didn't happen anywhere in this area here. It's possible it's happening in December of 2022. This is global tech stocks here with an ugly weekly reversal near that all-important 200-week moving average in red. This is as of Thursday's close. NASDAQ 100 flirting with the 200-week in blue here and the 50-day in blue here. This is a concerning look here. Just look backwards. Can you find anything like this? You really can't. This is the most concerning look on this chart. And that's based on the moving averages and price action. This is even more concerning because you're so extended from the 40-month moving average here not surprising that you got a drop like this. But price action here, relative to the trends, something needs to change here relatively quickly. And that may happen. It just hasn't happened yet. NYSE Composite, rally off of that October 13th low. Here's the trend line. Here's price in the present day. Breaks the trend line, makes a lower high relative to this high, and this week printed a lower low. Speaks to the probability of a trend reversal. Tweeted this chart here. This is the 200-day moving average for the NYSE Composite. Price is removed. It lets us focus on the slope of the 200-day. If you're a stock market bull, this is not the slope you want to see. So when you have a slope that's down and you're rallying, the probability is higher that this is a counter trend move. If you're a bull, you want price to stay above. You'd like this to flatten out and turn up. It may happen soon, hasn't happened yet. Big caveat here, this is an intra-month chart as of December 15th. NYSE advanced decline issues. Below the center line on the Bollinger Band, near the lower band. Below the center line and near the lower band is not particularly a good look. You can pause your video player here. This is what a constructive move looks like. The breadth indicator, this is the NYSE Composite down here. Here, we're below the center line. We make a discernible lower high. You can make an argument that this looks similar to this lower high and looks similar to this lower high. This is what happened with price, and this is what happened with price. Doesn't predict anything. This chart is as of Thursday's close, but the S&P 500 was down on Friday, so it looks worse at the end of the week. You can read this little blurb here, but closing below red says the probability of this, A, being a counter trend move, and B, that the counter trend move is over after this close, those odds are higher. Notice at the COVID low, you clear red, you really don't even flirt with red again until January of this year. And not much going on relative to the bullish box here. Hit the trend line, can't get back to it. Hit the trend line, can't get back to it. Hit the trend line, we couldn't get back to it, especially on a closing basis. Intraday, we were way up here. Just as the 3,900 area is and was important earlier this week, this gap here, the first CPI gap up in the S&P 500, the lower portion of the gap, is at 38.18. 2 o'clock on the 16th, we were trading at 38.34. This could act as possible support even if we're going to go to lower lows. This could be short-term support. We'd like to see what happens here next week. Friday's session, December 16th, around 1 p.m. Eastern Time. The longer we stay below 39.14-ish, the more relevant it becomes. 3,800-ish is also important, but not as important. It should be easier to blow through this level relative to this level. This is the 50-day moving average. The S&P 500 closed on Friday about 12 points below the 50-day. The longer below, the more relevant it becomes. Notice the slope is also getting a vulnerable look. Trend rolls over, trend rolls over, trend rolls over. Very similar look, this tight look here. The tighter the look in here, the more concerning it is. We also have to take this in the context of price being below 3,900. December 8th tweet talked about a concerning momentum reversal, daily momentum reversal. This is a similar look here. You can pause your video player. Monthly trends, exponential 8 and exponential 9. You can see eventually blue overtakes red at the major low. Blue eventually overtakes red at the major low. December 15th, blue significantly below red, and both of them turning back down. This look here is this look here. Looks a little bit like this look here, or maybe even this look in here or here. If you're a stock market bull, is it possible it looks like this? There's some similarities. Blue, below red, concerning. 2001, 2008. Weekly stalling near the 20-week, and thus far we haven't cleared any of these levels in terms of weekly RSI. This is a zoomed in rollover look of this area right here. Still can make an argument that this in here looks similar to this in here. TSI couldn't recapture 0, couldn't recapture 0, haven't recaptured 0. Make an argument that this point here in August is similar to this point here, December 16th at 1:20 p.m. Eastern Time. Not much going on here. COVID high, this is that 2020 cluster that we've talked about in the past, somewhere in the neighborhood of 3,400 to 3,200. In its present form, present day is not an encouraging look. The MAs are tighter here, they're much tighter here, much tighter here, and much tighter here. A lot of white space that we can see in here, quite a bit of white space. White space. Weekly chart, intra-week was up here. This is the look, 11:27 a.m. Eastern on Friday. Still have some areas of potential support here. Momentum, rolling, daily chart below these levels here. We've shown a lot of charts where we're up against a downward sloping trend line, meaning possible inflection point. This is really not what we want to see at a possible inflection point. This is an ugly weekly outside bearish reversal for the S&P 500. We exceeded last week's high here, intra-week, up around 4,100, and then closed well below last week's low. You can make an argument it's similar to this bearish engulfing look here earlier this year, and this is what happened after that. Weekly MACD or momentum nowhere near recapturing the 0 line. The COVID peak here, 3260 on the S&P 500, coincides with that important cluster area here from 2020. Why is this level here potentially relevant? COVID high, COVID plunge. Because we have other indices in 2022 that have already revisited the COVID high and COVID plunge level, telling us if, hypothetically, price comes back in this area, it may be relevant. Not a prediction in any shape, form, or fashion. Keeping this 3260 number in mind, covered this many times, you can pause your video player. This shows us hypothetically what our drawdown, maximum drawdown, might look like based on this high here in January of this year relative to the history of bear markets and recessions. We're looking at non-recessionary bear markets and recessionary bear markets. We have a lot of data in hand that tells us the odds of a recession are quite high presently. Thus, remember that 3260 level here, COVID peak for the S&P 500? History says we could undercut that. This is sitting below 3,000, and this would be hypothetically below 2,800. Thus, even if we just had the median decline for all bear markets, including bear markets where the economy avoided a recession, based on this peak here and the historical median drawdown, we'd come back roughly to that COVID peak. We're not forecasting here. We're just trying to understand a wide range of outcomes based on how human beings have acted in the past. Sometimes markets like symmetry. This is a known. This is a known. If we take this angle and move it up here, you can see the rally move back roughly to that level. If we take these angles up here and move them down here, based on this low, hypothetically, there's a lot of white space between price and these hypothetical trend lines down here. This is 3,400. This is 3,350. Clients and regular viewers may remember way back in April, historically, when the S&P 500 was down 5% or more at the end of April, as it was this year, your average and median drawdowns, additional drawdown in the historical cases, hypothetically, would take us to 3,450 in the present day, or somewhere in the neighborhood of 3,350-ish. It coincides with a very important volume by price band on the way up after the COVID low. Remember, the bond market, at least this portion of the yield curve going back to 1990, looks similar to this point and this point here. This is the year 2000. This is the S&P 500. The term recession is becoming more and more prevalent in the headlines. along with the term fear. And since human beings tend to think a little bit better in percentages when it comes to money, if the S&P 500 is trading around 3,850 as it is in the present day, and hypothetically it comes down to 3,000, that's approximately a 22% additional drawdown. That would be in addition to the drawdown from this point here back to this point here. Keep in mind, already been back to the COVID high, and then think of this level in the context of what we just covered. Not a good look here. Weekly momentum, MACD well below zero. What does that mean? That means this is considered to be a counter trend move within the context of an existing downtrend, just as this would be a counter trend move within the context of an existing uptrend. You can pause your video player here, compare this period, this look, to this period in 2008 and this look here. There are some similarities. There are also some differences. The 30-week moving average here that we've covered in the past, this is Thursday's close. Stocks were down on Friday. We want this slope to turn up. In terms of bullish probabilities, this is the look as of Thursday's close. Just as we most likely saw programmed buying down in here from October 13th walking forward, we also have to understand we may be seeing some program-based or forced selling as the market falls. This concept here and another relevant concept here. This is the present day look, weekly cloud relative to price. You can compare it to all periods going back to the 1990s. I think it's fair to say from a trend perspective, especially monthly and weekly trends, the jury is out on the 10-year yield, the US dollar, and for the most part, all bond ETFs. Here's an example here, US dollar weekly Thursday's close. You're still checking a lot of bullish boxes here, but you do have blue dropping below red, and that is different from anything we've seen in here. You can pause your video player and study these charts. This is Tech Communication Services XLC relative to SPY. It's a weekly chart. 200-week moving average, this is what's happened. Now, XLC is now starting to flirt with the COVID low down here, and really is all the way back to levels seen in 2018. This was the extended look relative to the 200-week. If you take SPY relative to TLT or QQQ relative to TLT and look at the same 200-week, we know without a shadow of a doubt, or at least history says, at some point this ratio will come back and revisit this 200-week. Here's ARKK last year, extended from that 200-week, now well below it, and down near the COVID low. This aligns with the recent jury is still out comment. Bond ETF, some progress, haven't flipped the trend yet. Since they are extremely large capitalization stocks, Apple, Microsoft, and Alphabet have a big impact on what happens in the major indices. Weekly Apple here, vulnerable. Weekly QQQ, really not checking any bullish boxes. Weekly GOOGL or Alphabet, ugly. Weekly Apple, still extended from the 200-week moving average. Momentum down here below zero, very, very weak on this attempted push higher. It's the daily cloud here, Friday, 2:42 p.m. Eastern Time, below blue, below red, looking more vulnerable. And maybe more importantly, the weekly chart, above red, counter trend move is over here in August. We went above red momentarily, closed back below red this week. Doesn't predict anything, just speaks to odds. If Apple is vulnerable, then the market is vulnerable. Midcaps, this looked like a very, very impressive breakout a couple of weeks ago. Now we're all the way down here on December 16th. NASDAQ 100 relative to the S&P 500. You can compare the dot-com bust bear market to the look on December 16th. QQQ relative to SPY, the all-important 200-week in red. NASDAQ 100 triple Qs relative to high-yield bonds, HYG. That looks like a topping pattern. We were vulnerable here, vulnerable here, vulnerable here. We're vulnerable again. What's different this time? Probably fair to say those two words. Recession fears. Daily, SP low volatility relative to the equal weight ETF or RSP. Ratio clears the 200 week. This is the COVID plunge. Ratio clears the 200 week in Q4 of last year. S&P peaks. Ratio right now has cleared an upward sloping 200 week. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. This looked like a bullish breakout, and it failed. That's why we say the longer above, the more relevant it becomes. It applies here. Right now, it looks like a breakout. Is it going to hold? We'll have to see what happens. Remember earlier in December, we said it's possible that bonds will significantly outperform stocks walking forward. This is December 15th. This is basically SPY divided by TLT. Month to date, as of Thursday's close, bonds beating stocks by 9.29%. Extended up here, came back to the trend line. Extended up here, came back to the trend line. We've been extended for quite some time. That doesn't mean we're coming back to the trend line, but momentum down here does have a slowing look to it. And usually when you get this much white space in here, we at least know one thing. The risk of a reversal is higher. It's the dot-com bust bear market, the financial crisis bear market, blue below red in the present day, XLK monthly. Not a good look. Weekly, above red. This looks like a counter trend move. Now we're below red. Doesn't predict anything. Speaks to odds. The S&P 500 index peaks right here in October of 2007. Turning up look above the ratio. This is the present day look. XLY divided by XLP, rollover look here, rollover look here. This is a bullish look, this is a bullish look, and this is a bullish look, allowing you to compare and contrast. Conviction at the June low into the August high, much, much higher than it's been down here relative to the October low. For the most part, all of the bullet points that we covered back on November 18th still apply. Is it possible a new bull market has started? Sure, it's possible, but right now it still looks like a counter-trend rally. Back on November 18th, history told us very possible that the market would go back to 4,100 to 4,300-ish and still be in a counter-trend rally. We hit 4,100 this week. Doesn't mean it's over. This is still well within the realm of possibility, as is a major low. Back on November 18th, we said risk appetite needs to pick up. We just showed you a chart where it doesn't look like risk appetite picked up. Talked about this in this week's video. This is still true. And now, instead of pushing the counter trend envelopes here, now they're looking like failed bullish breakouts. We know the odds of a recession are high. We know earnings typically take a hit. We knew that back in November. Still applies today. And if you use easy multiples and easy projections on earnings, it's very easy to understand how the market is presently overvalued if earnings drop. These numbers haven't changed. And from a timing perspective, this is still the same. History of bear markets tells us wouldn't be shocking to see the low come in Q1 or Q2 of next year. As we get closer to that low and the market looks ahead relative to the Fed backing off, we could see those trends in bonds flip. They haven't flipped yet. Probably makes sense to be ready. Still applies, still reading from the 1970s script. It was relevant on November 18th, and it was massively relevant this week. Fed chairman said inflation is still running core inflation 3 times higher relative to what we want to see. Nothing new here about an open mind, and this is still very true. Destinations remain relevant. The terminal rate. Has the 10-year yield hit its peak yet? Has the 2-year yield hit its peak yet? And if the S&P 500 moved from 3,500 intraday all the way back to 4,100 or 4,300. For a longer-term investor, if we're going to backtrack to 3,000 in Q1 of next year, this becomes a counter-trend rally. Another way to say this is tape reading. As always, all of the commentary in this week's video is based on the facts and charts that we have in front of us. If the charts and the facts change, then we need to be willing to reassess the probabilities. The S&P 500 is still above potential support areas near 3,800, and it has that first CPI gap as well. Even if the market falls early next year, a counter-trend rally is quite possible. No assumptions relative to any topic or any time frame. And we all know, in a very difficult environment, it's extremely important to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.